Good day, fellow investors. We continue with our analysis of Warren Buffett stocks to buy. Yesterday we did the free pharma stock, so if you haven't checked that video too. Today I'm going to do Verizon, another very interesting dividend stock that Warren Buffett bought. I see 10% returns yearly over the long term, which is something that compounds. And let's see here why Warren Buffett bought. Chevron, I promised it tomorrow. I'll do it by the end of the week because tomorrow there is a big investor day and we'll make a bigger video also to update in general on the oil sector. Let's start with Verizon. If you like these stock analysis videos, make sure to smash that like button because it supports the channel, and then the more people see stock analysis videos, the more I'll do them. On Verizon, we're going to check the stock price, why Warren Buffett bought, how much he bought. We're going to do a comparison with other public stocks that I have analyzed. Of course, this list is downloadable for free in the link in the description below. And we're going to make a Verizon valuation, and you can see how the intrinsic value is slightly above the current stock price of 56 for a 10% return. Let's start. What's very interesting with Verizon is that it is the second largest ever Warren Buffett purchase. He spent $8.6 billion on his current position. The stock price is a little bit lower than what he paid even, so that's an opportunity for us. I'm saying the second purchase. The first purchase is of course Apple with $31 billion spent. Of course the performance there is stellar. What's there? 4x up on Apple. Bank of America, he did a convertible bond deal, so I would not categorize that as a purchase. And then the second largest purchase, here we go, Verizon Communications. So very interesting to look at it now, as we can still buy it at the same level Warren Buffett bought. If we look at Verizon's stock price, you can see how over history it is a slow and steady compounder. We have seen exuberance, of course, in the dot-com communication bubble, then a lot of years of nothing, and then as interest rates went down, dividend stocks also did well, and here we are now. And now, as an investor, you might wonder why Warren Buffett is buying here, why did he buy here, and why didn't he buy earlier when it was much cheaper? Well, Warren Buffett looks for stocks that have confirmed themselves. If we look at his recent purchases and in general his purchases, we have low price earnings ratios, high dividend, growing cash flows, and the most important thing, strong business position in a growth sector. By strong business position, we look for companies that have, let's say, a position that nobody can take, a moat over the long term that will return more and more cash flows over time. And the current situation and the likely situation in the future is that there are three players in the sector: Verizon, T-Mobile, Sprint, and AT&T. And Buffett has likely identified that Verizon has the largest scale, which leads to the largest profitability, highest profitability, which leads to steady growing dividends in the long term, a good business, a good return, good enough for him to put $8.6 billion in it. Now, on the business overview, we can talk for years about the bands, about what they are doing, about how they are doing it, how they are competing with AT&T, T-Mobile, are they catching up with T-Mobile or not, how they just spent the most for the C-band auction now, and when it comes in, it comes earlier than T-Mobile, etc., etc. But let's do a Buffett perspective here. If we look at return on invested capital, and Charlie Munger always says that your investment return over the long term will likely be in line with the return on invested capital. And if we look for Verizon, you can see here teen returns over invested capital. That is also what Warren Buffett is looking at, high returns on invested capital. Comparing to the competition, we have T-Mobile, Sprint. Look at this, return on invested capital, not in the teens, but in the high single digits on average, and you can already assume AT&T even lower over time. And while Verizon is having high profitability, AT&T's numbers are much lower. So it is the laggard in the sector. I made the video on AT&T also. It is here in the comparative table. I haven't updated this, will update over time, but you can check the video here, and you also have the valuation. You can compare it to, I think this we put cash flow, so market cap, and you can compare the valuation there. So we have Verizon, stable business, good market position, likely moat over the long term. There are also risks that we'll discuss in a moment, but if we look at it all, the dividend will likely grow, the cash flows will grow. There is high investment now in the 5G, but it's unlikely that the free players there in the oligopoly are going to go into price wars, etc. They're going to have a steady, profitable future, and that's what Warren Buffett is banking on. If we look at Verizon, the revenue, slow and steady growth over time from 110 billion to 130, nothing stellar, but if we look at operating income, it has increased from 12-13 billion to 28 billion, so higher and higher operating income, higher, slow and steady, higher dividends. And what always he's looking at is operating cash flows that are now at 41 billion, which allows them to spend 15, 16, 20 billion per year in investments to keep their investing position strong. But as the operating cash flows grow, as the capital spending is stable, the free cash flows are higher, which allows for debt servicing, higher dividends. And perhaps also the key with the capex is now we have high investments, as we have seen with the C-band investments in 5G, towers, etc., etc. But in a 1, 2, 3 years, 5G will be positioned, will be done, the capex will start going down, and the profitability is likely to start going up. And that's always Buffett's mindset. Worst case scenario, I have stable cash flows, I have a good dividend, I have a low price earnings ratio, and then, yes, it's uncertain how will the market look in 2025. But that was the same for Apple when he bought in 2016. It was uncertain how much growth there will be, but the baseline cash flows were pretty certain, and that's something that Verizon reminds us now. Apple 2016, perhaps less potential growth, exuberance over the long term, but high, slow and steady, boring growth, higher dividends, higher stock prices. So here is the Verizon stock valuation. I have taken the dividend because that's what Warren Buffett is likely looking at, and perhaps no fast dividend growth in the first years, but then when the 5G capex subdues, more and more cash flows, the debt is serviceable, 100-something billion compared to 40 billion in operating cash flows, not that much of an issue. So I have put a 7% dividend growth rate in the first 5 years, and then 10% as they reach profitability with the 5G, a 5% dividend yield expected in 2030, and that leads to a stock price of almost 100 for an intrinsic value of 58% for a 10% discount rate. Also, you have to see how you are taxed on the dividend, because that has also a significant impact, and you can change here the number, multiply, deduct the dividend with the tax you're paying, and then see what is your intrinsic value for what kind of return. In the best case scenario, let's say the dividend growth is even faster in the long term, and the market is happy with a 4% dividend yield. We have more than double stock price and higher dividend for an even higher intrinsic current value. And I think also that is Warren Buffett's scenario, investing scenario, where he sees that he will get a good dividend, growing dividend over the next 10 years, 20 years. That's like his Coca-Cola purchases. Just give me those dividends, I'll reinvest them, compound, and boring long-term investing. But that's Buffett, and that's what made him one of the richest persons in the world. If you can, enjoy your life, do some other things, sports, hobbies, whatever, and you want boring investments that you don't have to think about, then Verizon is one option. If we compare it into our comparative tables, we see that it gives likely a 10% return, good dividend, which is in line with REITs that are perhaps even riskier than Verizon. AbbVie also there, a good, interesting position. So you have to see what best fits your portfolio. I will keep looking over the month and see whether I will add something of this on to my large portfolio. There is also USD risk with Verizon and these companies for international investors. That's also something to just keep in mind and see how it fits your portfolio. On the other risks, there is debt, 107 billion, I think, but think of these companies. If Warren Buffett owns a stake, let's say you enter into debt issues, you just call Warren, would you like to give us a convertible bond of 20 billion with a 5% interest rate? And Warren says, yes. He puts in 20 billions in the company, the debt issues are gone, stock price goes up, Warren Buffett converts his convertible and doubles his money like he did with Bank of America. The company is strong, everybody happy. So that's also a risk mitigation, Warren Buffett's stake, which gives again a margin of safety if there are debt issues. Other risks are, of course, competition. You never know how the competition is going to react, price wars, investments, liquidity, and of course new technologies. But at the end, it's also about physics, what's there next, how much you have to invest, energy consumption, etc., to build the infrastructure that is already there and will be there and will be owned by the three big companies there, and the biggest one, Verizon. So the investment theory, I think the dividend might double over the next 10 years, and therefore also the stock should double, which is in line what happened over the last 20, 30, 40 years, slow and steady, doubling, high dividend that you can reinvest, and you can get rich slowly, which is what Warren Buffett has been doing all these years. And of course, another investment catalyst, not now, but in the next 3-4 years, there might be a possible jump when these 5G worries, capex subdue, when there is increased profitability, lower capex, you might even see those returns come earlier to you. So let's say that the stock might double even in the next 4 or 5 years, which is again a positive compared to the risks. On a more conservative basis, I would say the stock could double in the next 10 years. So see how this fits your portfolio, check my template, click on the links, enjoy the researchers, and if you want to see what I own, even higher possible returns, globally emerging markets, please check my stock market research platform. There is a 28-day money-back guarantee, so you can check anything, everything, compare, see how fits your investment requirements, and then see whether you will get value there in the very, very long term. Thank you for watching, looking forward to your comments. I'll see you in the next video.